Trade finance refers to the financing and facilitation of international trade transactions. It involves various financial products, instruments, and services that help importers and exporters mitigate the risks and challenges associated with cross-border trade. The primary objective of trade finance is to provide liquidity and ensure the smooth flow of goods and funds between buyers and sellers involved in international trade. Trade finance encompasses a wide range of activities, including export and import financing. This involves providing financing to exporters or importers to support their trade activities. Export financing helps exporters bridge the cash flow gap between production and receiving payment, while import financing helps importers finance their purchases from foreign suppliers. Letters of credit, LC. A letter of credit is a payment mechanism that guarantees the payment to the exporter upon the fulfillment of certain conditions, usually related to the shipment of goods. It provides security to both the buyer and the seller in a transaction, as the payment is assured once the terms of the LC are met. Documentary collections. In a documentary collection, the exporter entrusts the handling of shipping and payment documents to their bank, which forwards them to the importer's bank. The importer can only receive the documents, including the title to the goods, upon payment or acceptance of a draft. Trade insurance. Trade credit insurance protects exporters against the risk of non-payment by buyers due to commercial or political factors. It provides coverage for losses resulting from insolvency, protracted default, or political events that prevent payment. Export credit agencies, ECAs. ECAs are government or quasi-government institutions that provide export financing and insurance to support national exports. They help mitigate risks and provide financial assistance to exporters in the form of loans, guarantees, and insurance. Supply chain finance. Supply chain finance involves optimizing working capital along the supply chain by providing financing solutions to suppliers, buyers, and intermediaries. It aims to improve cash flow and reduce the financing costs for all parties involved in the supply chain. These are just a few examples of the various tools and services involved in trade finance. The specific instruments used may vary depending on the complexity and nature of the trade transactions, as well as the requirements and preferences of the parties involved.